So I think we're coming up, 5 past the hour. We can kick this off, Stefan. So yeah, everybody, this is, the Wealth and Whiskey Mastermind. We keep it pretty loose. We just talk about wealth building strategies. We primarily focus on, real estate investing, but we've had many different guests on here to talk about different strategies to help grow and protect your capital. So we'll do that the first half. And Stefan's going to be our guest today. He's going to be talking about some of his strategies, and I know he's heavy into analytics and market analytics as well. So it'll be interesting to talk about. But if you guys have any questions, feel free to post them in the chat. We'll get to them as soon as there's a lull in conversation or it makes sense. And then we'll, once we go through that, we'll get into breakout rooms if everybody's still around for that. Some people like to leave early before the breakout rooms, which is not an issue, but we'll do 3 or 4 people per room. You get to kind of network with people a little bit better on one-on-one. So, but yeah, Chris, did I leave anything out?
Yeah, and if you don't know, we are Valkere Investment Group.
That's right.
We buy multifamily assets with other partners, and we're now looking into assisted living.
We're buying one.
Yeah, exactly.
We're under contract. Yeah.
So my name is Chris. Oh, that's my brother Ashton. Somewhere.
I should have introduced myself. My bad.
Stefan, all on you. Take the floor. You can share it too.
Hey, thank you guys for inviting me, first of all. So my name is Stefan Tsvetkov. I'm your, speaker for today. So you guys want to do...
Go ahead.
You guys want to do it because I have a PowerPoint. It's it's pretty technical. It gets a lot of slides. We are here having drinks, etc. So whoever you guys prefer, we can do more conversational, or I can show you a few of those slides as you guys prefer.
Yeah, maybe kick it off with a couple slides. Explain who you are, your background, and how you got to where you are today. And then maybe go into the slides, and that'll get the conversation started, get into some questions as well. I know we've talked before, but a lot of these gentlemen probably don't know you. So.
Sounds good. Okay, let me share my screen. Okay. So this is from a presentation on data-driven investing. So I just kind of want to give you some overview of myself, what I do, kind of the approach and mindset that I have in real estate. So I'm a financial engineer previously. So I used to manage a 90 billion derivatives portfolio jointly with several colleagues of mine. And I have been a multifamily investor in the last few years, doing a few different strategies, as well as having, have published a few metrics and analytics for different stuff, and I'm going to go over that as well. So my real estate investment company is Pepel Capital, and I'm founder of NV Analytics, an investor-geared real estate analytics system. I also organize a webinar called Finance Meets Real Estate, if you guys want to check it out. So data-driven investing. So first of all, what it is, my perspective on that is the following. So there's different techniques and things you can do, and I just kind of want to give you, I don't want to burden too much with overly much technical stuff, but I want to kind of give you what's out there, so that you guys can take it perhaps and use it in your business, and or maybe just take the mindset or see a different mindset and that. So data-driven investing to me is one of those 6 things here. There are other possible options as well. So on-market listings data. So assuming using on-market listings data, it's pooling and performing end-to-end automated underwriting. So there is no manual underwriting, or minimal manual underwriting. The goal being everything to be end-to-end programmatically via code or scripts. Now, off-market commercial multifamily, other commercial real estate, extracting data, modeling value add on those off-market properties in a kind of scalable, automated fashion, expanding on essentially what purely inventory feeds and with owner data, etc., from Reonomy, etc., have. Performing on the market side, performing statistical regression analysis on markets data, for price, income, population, housing supply, etc., deriving best appreciation and downside predictors, and sort of having an intuition across, like it's not just, okay, selecting a single market, or this is the job growth, this is the, like population growth, etc. It's more like, okay, having the intuition of, okay, how are all counties in the US performing, how do they stand relative to each other, etc. There are other techniques that are on the more like machine learning side. So one is automated valuation models. So that is very useful on the investing side as well, or can be very useful. So that is what Zillow does with their Zestimate. That is the basis of the iBuyers industry. So if you guys know Open Door and companies like that, so it's pretty much the reason why they exist is the presence of automated valuation models. It's not easy to price houses in an automated manner. People like Zillow CEO, they talk about it. Okay, they try to hire also real estate agents, people who know the industry well, to inform the modeling process. It's quite challenging, and also across like different property types. Like more, less sort of more opaque markets, etc. There are other things. So another thing is, so the sixth item here is computer vision. Computer vision is useful. Why? If you want to underwrite properties, now you're going to be fed like hundreds, or okay, maybe you're going to fed like tens or hundreds or maybe thousands of properties, and you want to kind of have some preliminary analysis or preliminary underwriting of them. So you can automate a lot of the computational side. You can compute your cap rates, etc., etc. Some of the parts that are harder is, okay, who is going to review the images of those properties? That's where computer vision comes in. There a company for that you guys can check out is called Foxy AI. I'm in the New York City area, so out of New York. So they do condition scoring. So I have no affiliation with them. It's just a product that I thought it's good. So they have so their product would give you, let's say, like a score of 1 to 5 of the condition of a property, like based on its photos. So of course the goal is it going to align with your intuition as a person? So that's kind of the goal of that. If it does, then that gets you automated to a level where you can do it in a scalable way across like thousands of deals.
Cool. Hey, yep. Stefan, quickly, where does it get all the pictures then? Are you providing them the pictures, or the sellers?
Yeah, so Foxy, I have just done like a trial for their service. I haven't actually signed up for it, but they, you just kind of feed them the images, and they can tell you, like if you give them like a unit or a property, they can tell you, okay, give you a score of, let's say 5 is really good condition, 1 being not good condition. So that's pretty much the goal. Is okay, what would you as a human, let's say, decide following looking at pictures of property, right? You would kind of classify it, like bucket it in your head in a certain way. Yeah. So that's machine learning. So that's like the AI part, like artificial intelligence. That's something that they do. That's very useful. Then you have on the textual side, so if you can have your algorithms read, so they can read, okay, then you don't need to do it, right? So that's the NLP. So if you are able to, read listings or whichever off-market descriptions of off-market properties, even assuming there is a database of those, or like reonomy feeds or however, if you can read like textual fields, have certain classifications. I think like one of the most, you can do it for various things, but one of the more challenging ones is condition scoring, I feel. So if you can classify, okay, like listings that say property sold as is, or etc., like these kind of phrases and so forth. It's a different method that they use in NLP. It's called word embeddings. It's not like simply, okay, these similar phrases, they mean that it's not in good condition, etc. It's more like, it's kind of doing like numerizing the space of words and everything. And it's like really interesting as an approach and technique that they have actually. So that's another like machine learning technique that one can use for that. And it gets pretty technical. One can hire people to do it. But again, the concept here being, you can, thereby you can automate human intelligence. If you automate human intelligence, that really scales, that improves your business. And so I'm kind of here to show you like some of the things that I've learned, so that, maybe it helps you as well. Another item I do not have here, if you look up a company called Lofty AI, so they recently transitioned to like tokenized real estate investment, kind of like investment fund structure. But what they used to do was like very like highly topical or like highly focused neighborhood like appreciation predictors and things like this. So that is not simply like, okay, the item that I have here, market analysis, where you're pull like the governmental, county, etc. data, but actually like trying to find neighborhoods by like social media signals, you know, where you're going to have, let's say, this neighborhood, maybe a coffee shop shows up, or you know, like different, or what kind of pets people have over there, you know, these kind of signals of, you know, of wealth, or call it, or a demographic change in different areas. So that is another, I would say, like seventh item I didn't put in here. That's a pretty great one. Okay, then what's not data-driven investing? Well, manually underwriting deals. So it's, you guys have done it, you know, it takes a lot of work. It's really hard. I do it myself manually as well. It's really hard to have everything perfectly automated. In the end, like you have like the need of human intuition, etc. The goal being like trying to minimize that as much as possible. But yeah, so that's not manually reading property description, inspecting images, etc. Is not data driven. What's not data driven is also performing like sort of not pulling lots of off-market data, let's say in the off-market space, like getting like prospect now feeds, etc., but not performing analytics on top of it. So that's kind of, in a way, well, that's kind of, okay, you have data, it's maybe I can say partly data driven, but then not actually using it in a meaningful way. Then another, I would say, kind of very trendy one, okay, kind of selecting like several markets, you know, like you pick a market, let's say Atlanta, Georgia, or whatever, and kind of back reason all the reasons why it's a great market. So, you know, kind of back reason, it has population growth, job growth, etc. It's not data driven in my view, because it's a single data point. You pick that one market, you don't know like the population of like 30,000 counties in the US, or you know, multiple zip codes, etc., how they compare. So yeah, manually gauging property values, sort of manually trying to, like, by your neighborhood knowledge, to assess, okay, how much should this property be worth? It can be useful. Yeah.
And so some of these are for the market, and then some of these are for the actual property, right?
Yeah, exactly. Yeah. So it's pretty much, yeah, property, I'd say, like, yeah, property analytics, like for finding deals, and then the market analytics as well. Yeah. I mean, the property analytics is majority of the work. I think it's like 95% of the work, at least for me, because, you know, that's the hard part. And you have like so many, you know, so many variables, and it's, at least for me, has been harder. And I mean, another thing I would say, okay, just like another example that I see like from people, and I have like a post on LinkedIn on that. Let's say you read a report that in itself is data driven. Does that mean that you kind of incorporate the knowledge in, like, kind of, it becomes part of you? Not really, right? So that's like reading a Marcus and Millichap report that is great, that is data driven, it has quality content, and it's kind of summarized in the end. It is data driven, but it doesn't give you well, the report itself, but it doesn't give you intuition about the data, and it doesn't give you experience. Most of the time when I do this, I don't internalize the knowledge, and I kind of end up, okay, now I kind of end up not trusting, you know, what is it? It's the same way if you take like my reports or etc. Now you're going to say, okay, it's like, you know, you can quickly forget about them, you know, probably. So it's a different, it's more like getting like in the habit, getting in the mindset, like kind of seeing the value of, okay, that's something that's going to improve your business. It's a different approach to kind of the same thing that is presently being done, and etc. So another thing is like utilizing no risk management. So real estate is a fundamental asset. So downside predictors actually work in real estate. I've been talking a lot about this, different events. Downside predictors work. The reason why they work is the drivers of price changes are fundamental. We kind of inherently know it. It's job growth, population growth, etc. You know, income levels. And so that's, so any overvaluation relative to that is sort of a measure of your downside risk, is actually to an extent measurable. And yeah, so that's like not utilizing risk management techniques. So from here, okay, so I had included two topics, gonna be like too much, I think, like to go over. Like one is like market valuations, another one is modeling like commercial multifamily value, like for you guys, like Chris and Ashton, who do like commercial multifamily. So this is kind of like a model to kind of for off-market commercial multifamily to kind of get a preliminary analysis into it. So like the goals being, okay, to kind of get acquainted in a general, like high level sense with data-driven principles and techniques, sort of learn what markets, or let's say at least call it states and counties, are overvalued right now. A step-by-step guide to building an automated, scalable process for off-market multifamily analysis, as well as to inspire a new vision and mindset for real estate investing. So that so the first part was very interesting to me personally at the beginning of COVID. So I was just looking, I wanted to find out which states and counties, for lack of more granular data, which states and counties that dropped in price past the during the global financial crisis. What caused that? Was it like differential foreclosure rates, etc.? They're states that tend to be constantly kind of on the kind of violator list of like the most foreclosures, like Delaware, Illinois, etc. Is that what drives downturns post a peak, or is it maybe like the different markets perhaps, or states or counties? I know that's not a market, but just kind of high level discussion, right? Like different states or counties, maybe they have like different, like different other fundamentals that drove their downturn. And yeah, so those are like the drops post 2007. And this is a study I did at the beginning of COVID, just to give like as to why I did it. I did it for myself, for the purpose of, I wanted to know if I invest in a particular market, should I be concerned, like, like constant question, is real estate in a bubble? Should I be concerned that it can take on a downturn? If yes or no, like to what extent this is like, to what extent are sort of is the current state of things, and like to what kind of magnitude of a drop I can expect, etc. in the event we hit the peak of cycle. So I did like kind of a back study of, okay, what actually happened during the global financial crisis, knowing that that's the biggest real estate documented crash in US real estate history. So there were like 4 states that you see on the map that dropped the most at that time. So those were California, Nevada, Arizona, and Florida. So as you see, like there were like 40 to like 56%, like significant drops. And then there were other states, and again, this is kind of a discussion in the state of like North Dakota, Iowa, South Dakota, even the state of Texas that barely dropped at all. And so I was trying to understand, so why did this happen? Why were there like states that dropped so much? Like the state of Florida, while the state of Texas prices, at the state level basically stayed the same. And so that was like some counties sort of like more granular for the Northeast. Just as an example, see that, okay, you can do it at the county level. But we can look at the data at the county level and like look at valuations. So I kind of wanted to take like from finance, like the concept of like a market valuation, like where's the market valued? Is it valued high? Is it valued low, etc. So an example of this being done in finance is John Hassman. So John Hassman is I think like PhD in finance, I believe. So he runs like Hassman Investment Trust, which is a hedge fund. So he had published like this study where he was, like testing like different metrics and their correlation to like subsequent actual S&P total returns. And so if you have like something like price earnings ratios, they have a certain correlation. Then they, in his team, they have built, okay, a better metric. Let's say that has maybe 91%. I haven't seen his actual study, sounds high to me. And that, so that's, but just as a concept. And then there was a study in, like different countries that was showing, okay, Canada by Neeraj Shah was showing like Canada, Scandinavia, Australia, New Zealand overvalued, and then US, and that was in 2019. And it hasn't been that different as of right now, actually. For now, it could change currently with inflation, etc. But as of late is, and so yeah, in US, like more like fairly valued. So before 2007, Ingo Windsor. So Ingo Windsor is a guy who runs Local Market Monitor. You guys have watched Neil Bauer, right? Neil Bauer, he uses Local Market Monitor for some of his kind of market data. So Neil Bauer, so he was at my webinar actually. He said that, okay, he was kind of saying that, okay, they do not reflect liquidity. Their model doesn't reflect the presence of the fact that, okay, there are there's like huge amounts of trillions of dollars poured into the U.S. financial system right now, which creates liquidity, which, like the sort of leads to asset appreciation, right? And so this kind of thing is not reflecting in their model. He was saying they keep projecting that prices will drop. It doesn't happen. So he kind of like looks at it with some caution, let's say. That said, Ingo Windsor, the guy who heads it, was on CNN like in 2005, 2006, etc. And he was talking that real estate at the time was dangerously overvalued. So he was pointing to specific markets, as you see here in California, Florida, etc. So he had like a certain metric on his side for that. So yeah, so the study that I did is the following. So I tested like different metrics, and this is like the simplest one that anybody can do. And I'm just sharing it literally for something that I would say that one can implement by simply pulling prices from FHFA or Federal Reserve Bank of St. Louis, or maybe Zillow or whichever source, and then pulling incomes from Bureau of Economic Analysis. And if you take a historical window that is kind of moving, but kind of a moving average window, and here I use like 20 years moving average window. And if you take, the deviation in affordability, so what's called like price income ratio, it's not a surprising fact, surprising thing, which metric is actually perhaps the most predictive. It's actually affordability, but it's not affordability itself, it's deviations in affordability. And when you do that and you take it against a historical moving average window, what you're accounting for is okay. It's not that price income ratios show if real estate is overvalued. It's that everything else does. So it's everything else except income. And then and also when you take it against a moving average window, it's not only just income, because price affordability is going to shift over time with, let's say, housing shortage. So you kind of inherently, without even knowing about it, the reason why it works so well is you inherently account for housing supply and population changes. The example of that is if you have like a place like San Francisco, maybe it had a price income ratio of 6 in the past, and maybe now it's like 20. So the reason is, there was like housing shortage happening, the place getting less and less affordable, but that does not make it overvalued. It's when this affordability shifts in an irrational way, like versus a moving average window. So that's kind of like the study here. So valuation being like percent deviation from historical price income ratio, and it showed it's in different data sets, 83 to 87% correlation on the state level versus subsequent actual price drops. How you see that on the map is if you see like the most dark blue 4 states of California, Nevada, Arizona, and Florida, and you look back to the downturns. So it's the most red ones, though. Those are the 4 states. So they're the ones that were overvalued. So the states that's the 83% correlation between this map here and this one. That's all. So the places that showed like the deviation in this metric, they actually dropped a lot. And then places like Texas, that as we saw, Texas had like only a 4% drop. So why was that? Texas was 5% undervalued at the time. As we know, Texas has been one of the best markets, and it's one of the big 2, so to say, for multifamily, together with Florida. But at the time, Texas was 5% undervalued. It's a little different now, and so it didn't drop, and so that was an interesting observation for me. I thought, wow, that's really.
Hey, Stefan?
Yeah.
I was just wondering, so how much of a leading indicator was that? So when you're looking at that data, how much of a lead are you giving it? 6 months, a year?
No, yes, yeah, great question, Andy. Yeah, let me tell you. So it is. So here, if we look at, let me tell you, yeah. So if we look at like the drops, so what are they? So I kind of took note on the side. So it's from the peak in 2007 that varied across different regions. So I have the same study at county level. So let's see, we have 3,000 counties. Like this specific county is, is overvalued, and that's the 3rd quarter of 2007. And then another one is maybe like 2006, it peaked and it already started dropping, or or maybe another one even like kind of lagged behind and peaked in 2008 or whatever. And so from the exact peak in every region, it actually took an average of about 4 years or 4 years and a quarter to reach to the bottom. If you look at just the price histories in government data, so the prices nationwide bottomed in like end of 2011, beginning of 2012, and it varied. Like, for example, like I've been investing in New Jersey, which is arguably not a great idea, but I'm in the New York City area. And so the New Jersey bottomed, and I haven't been investing at the time, but New Jersey bottomed in like 2013. And then other, like other states were like quicker, like 2011, et cetera. And so it varied, but we're talking of, so the drop that happened over the course of an average of 4 years versus where the valuation in that same region was before that. So it's actual predictive power. It's actually before that at the peak of each market.
Yeah,
So,
I guess what I was asking is, so like on your other visual where you're looking at the leading indicator essentially of the value, affordability compared to the moving average of wages, right?
Yeah, correct.
So if you're doing that, at what point when you looked at this graph, so if it says it's 68% overvalued, 49%, how long were those numbers essentially overvalued before the correction?
Yes, so that is a good question. So that varied. So in like 2000, around 2002. So yeah, so to know that, so you kind of like pull, like you have a full history of evaluations. So let's say like what I do is kind of have it quarterly. Like, so I have it quarterly, and same thing now today. So I kind of keep tracking it like all the time. So at the time, like if one looks at the history, so these same markets, they were actually fairly valued in 2002. So they were completely fairly valued. They were not at 50% and 40% or 60 or whatever. They were fairly valued, maybe like 0 to 10%. And what happened is that over the course of like 2-3 years, between 2002 and 2005, they became very overvalued. And then there was like people like Ingo Windsor who they have like their like sort of similar measures or models, and they were like some of them were speaking about it actually, and and that people others say, okay, you couldn't predict it, but that was actually the case, and so that's yes, so it took like about 2-3 years, I would say, to become very overvalued. As far as, I don't think like if something is overvalued, it doesn't, first of all, it doesn't actually mean it's going to correct. Second of all, it doesn't say anything as to the timing of it correcting necessarily.
Yeah, I was going to ask about that too, because if the government keeps pumping, printing money, right?
Exactly. Then it's just not going to happen.
Yeah, but then it's a relative thing, right? So like if you're looking at California at 68 versus Colorado at 11, maybe you could make the argument that everything's inflated across the board, but you need to start looking at relationships to geography.
Yeah.
Well, I agree. Yes. So I don't think this is not, I mean, again, like, it's not like an oracle or something predicting the future. Like when these things were overvalued, you still don't know when the market is going to drop, right? Or if it's going to drop at all, right?
But it just helps you hedge against risk, right?
Exactly. You have a measure of downside risk. That's all. You just know now if you're in California, it's at the current time, it's riskier than if you're in Texas, and that's all. You just have a measure of your downside risk, and so, for example, and let me illustrate it. So if you take the overvalued states, they dropped like a median, let's say 22%, and overvalued mean like let's say above 10% in this measure. And you can make like your own like other approach, let's say, but like 26% was the median drop in overvalued states. In fairly valued, 0 to 10%, it was 11% the median drop. Now the most interesting thing for me was, okay, what was the drop in the undervalued ones? So here were the states that were undervalued, and about 10 or you can count how many that were undervalued at the time. Most of the states were not. And so in the undervalued states, the median drop was 4% only. 4% was actually, well, the average, technically, the average income drop in the US after the, like during the global financial crisis. So one can argue that actually in valuation terms, they didn't drop at all. So this is a very interesting observation, because this kind of dynamic, like I come from a finance background, I don't think necessarily works like that there. Because it's just telling, at least to me, like real estate is such a fundamental asset. If you have, unless it goes overvalued, it doesn't just drop. People don't just sell their houses or whatever because even if a major correction, crisis happens, like the global financial crisis at the time, places like Texas and Indiana, which were undervalued, they had a very modest drop at the time. So that was an interesting observation. So it's like quite a different performance of the undervalued versus the overvalued if you look in as a group. And that's kind of what's feeding, like if you look at that's the meaning of a correlation of 83% or whatever. But that's at the state level. So I had.
And Stefan, real quick, we did have one question. This is real estate as a whole. We're not talking about any specific like single family versus commercial versus
well, it's not commercial, I agree. Yes. So now for commercial, so when I did this lecture back in July of last year, I put like a slide for like correlation of like residential versus like CoStar's commercial index and stuff like that. I mean, it's different. You guys know that it's obviously different. It's hard. It's a different valuation. The fact that it's a different appraisal method doesn't mean the two are not kind of going to converge at some point.
Sure.
I mean, again, like in real estate, you have your specific asset. It's always, you don't know what's going to happen to your specific asset. It may or may not drop like in different ways. And of course, you have your forced appreciation and all your like kind of regard that. So this kind of a different topic, but yeah, this is more like just the residential like 1 to 4 units, because that's where we have the most data. So
well, I think the biggest takeaway, and this is me because I try to oversimplify things because I'm a knuckle dragger and I've been hit in the head plenty of times. But I think the reality is you just have to buy right? Like I'm oversimplifying it obviously, but know where you're buying and know your risk, and then buy right. Like buy something at a discount because then you have less risk, and buy in those markets that you showed because it's less risk.
I agree. I mean, that's to the extent because you can find a deal. That's the concept of a deal, right? You can find a deal, and that's kind of, even if the market turns against you, you are kind of protected in a way. Now, but still you don't want, even if you find the deal and it's, let's say 10, 20% discounted or whatever, still you don't want kind of to have all that erased, like all your labor for finding that deal, erased by the market afterwards. So it's kind of both things, but I agree in real estate, it's kind of easier by virtue that you can find the right properties, etc. And yeah, I mean,
I think the other thing that's interesting is, some of these created feedback loops, like California, Nevada, Arizona, Florida, you had just builders and speculators just doing so much. And that was 20, 30% of the economy at those points in time. Whereas like you look at Texas, Oklahoma, Louisiana, and North Dakota, oil is a major byproduct in those areas. And they have other support factors besides construction to support them in the case that stuff happens, besides the undervalue too.
Sure. I mean, this is obviously just one perspective. I mean, this is really a perspective to downside risk. That's not, this, for example, like is not your predictors for appreciation or anything. That's a totally different story. If we have that conversation, I think in that sense, it's just that's kind of on the downside risk, what I found to be the simplest. I actually use a slightly more enhanced measure. So I kind of like add housing supply and population in it and kind of like do like a bigger regression, but it doesn't perform that much better actually than the simple ones. So it's kind of very much in line. And so this like the states, so that's like what the fourth quarter in 2020, governmental data tends to be like super lagging. So that's sort of quite right now. I mean, prices have been increasing, obviously. So it could be not or not, but so it's very fairly valued. Idaho at 25%, and like some of the essentially booming markets like Colorado, Texas, Nevada, Arizona are slightly overvalued, like 10 to 16%. So it's very, very, very mild. It's a very different story than it was before. Florida is at 9%. So that just in terms of, if we use the same measure that seemed to predict the downturn post 2007 of quite where it's right now. So that's what I see right now. And so those are like the only overvalued COVID. And they're really, when you say overvalued, that doesn't mean these are the strongest places. Real estate has trend. It's driven by autocorrelation COVID, and like it has a lot of momentum in most regions, not everywhere. An example of that is Florida. So the fact that Florida is just 9% overall doesn't mean, or Texas. I mean, these are or Idaho. I mean, we know what's happening in Idaho. Like there has been like huge boom and job growth and etc. So I don't know. So my expectation would be that they continue to grow. It's not like I expect something different. It's just as your downside risk measure to be aware of that once it ends, that's kind of going to most likely correlate the most to the downside after this. That said, like because of, again, like I said, real estate has momentum and it's trend driven, which is what I have seen at least in the data. I would expect an overvalued place like Idaho to continue booming and to be, and it actually did. So like when it did like this study also at the beginning of COVID, so Idaho was already maybe 22% overvalued and prices, rallied super much. So that's expected. But again, like at some point when once we reach a peak, these are going to be the places that will be more exposed. And it often is strong markets. It's not always the case. And so these are like some current fairly valued COVID markets, and the majority of it's not markets, it's just states. It's just high level discussion, but like these are the majority of states are actually undervalued in the same measure that they were overvalued in 2007. And these are, let's say, just to kind of inform market selection, this would be some places that are well performing, yet they're, let's say, under to fairly valued. So a place like, I don't know, Indiana, for example, so it performed well since its last fair valuation, and it's nevertheless still undervalued. So it's kind of more like mid-range markets that haven't been too much maybe exploited by investors, but they're still undervalued, but they nevertheless have decent fundamentals and have performed well.
Yeah, I got a stupid question. And you may have mentioned, explained this, or maybe I missed it. I don't know, but how are you? What does it mean, undervalued and overvalued, and how are you determining that? Is it based off of?
Yes.
You said based off of the price of the real estate versus wages,
yes.
Median income.
It's based. So undervalued means that the current affordability is below like a historical level, let's say, historical moving average level. So the current affordability is below where it has been historically. So
affordability is lower than it has been.
Yeah. Well, not right.
So that means, go ahead.
Yeah, when you mentioned the price to income ratio, so you're talking about people making income and what can they afford to buy, right?
Yeah, right. Yeah. So just the prices from, if you take Zillow or FHFA of homes in a given region, and then you take the median household income and just the ratio of that. But really the reason why it gets a little bit more involved, because the reason why this thing works, or is it, again, like I said, it's not price to income that drives the downturn or whether it's overvalued or not. It's everything else. What that means is you adjust prices. It's like you take normalized prices. You have prices, you normalize them by income. You're not trying to capture that. You're trying to capture everything except income. And then because it's a change, it's like a delta versus a moving window. Then in addition to normalizing to everything, normalizing by income, and so it's sort of trying to account for everything except income, you also account for that in that moving window, there are other fundamentals that have been built. So let's say the moving average has moved up, has increased because of housing shortage, and that kind of gets increased. So it's kind of a little bit misleading. It's a simple thing that works, but it has more in it. That's like housing shortage gets built in, but it's just like an estimate that kind of tends to work. And the proper way would be to try to account for all those different factors, but kind of it's also like you can do like overfitting maybe for your regression or something, like kind of like over modeling. So this
I think it's interesting. I think these are really interesting metrics because, and I was looking at this. So you had like Florida was one of, it was overvalued, but at the same time, but what I'm looking at places like that, I started thinking about it. So we were looking at like Sedona, Arizona. Arizona, Florida's a lot like this too, though. Like the prices of real estate are going up, and they're outpacing the price or the median income. But that's because there's so many tourists that buy vacation homes there, right? So the real estate goes up, but then you have all these workers that are doing minimum wage to maybe just above minimum wage. So there's kind of, it's skewing the numbers in that sense. Like Sedona, Arizona is huge like that. People can't, or like Sedona, Arizona, like ski resorts, places like that. It's really expensive to buy, but people are still only making minimum wage and they can't even afford to live in the city.
True. Yeah. So yeah, that's a great example. So, you know, that's why, look, if you, let's say, so that's why if you look at, if you do the same thing at county, let's say, like, or like you could say, let's say, like say a specific vacation spot or something like that, then it performs worse. So here it's 73%. 73% is actually much worse in my opinion. Because then if you look at like the numbers, it's predictive. It's still good because you're actually predicting kind of the future. This is like sort of a forward measure, but it's way worse. And so, I mean, that's why it's not easy to predict like small geographies to a point. It can be like you said, a situation where, you know, it's like a vacation place and actual wages are low. And, you know, it's challenging, but it's just, this is kind of like a high level, you know, like a high level approach. So at county level, you would see something like this, and one can look at some of the cities that belong to those counties. Yeah, that's kind of interesting. So so if you guys know, like, do you guys know like what has been the best performing like city in the US? If you, again, like, you know, like, because I like Neil Bauer, let's say, right? If you watch his stuff, I haven't watched too much of his stuff, to be honest, only like some, but if you watch, I watched his thing recently, and he was saying the best performing city in America is Boise, Idaho. It's actually, I think I have some statistics on that. I think it's coinciding from the top like 100 cities. But it's also the most overvalued one at the moment. So it's tricky. So it's Boise out of here's top 100 cities. In fact, out of 800 cities I had in data was the most overvalued city. And I kind of spoke it like at some events, and like, you know, like some people, okay, I mean, it has so much job growth, etc. I get that. You know, it doesn't mean it's going to correct, but it's just something to be considerate of in the future. I'm sure Boise is going to continue booming. But that is just something to consider. And then there's other places. So, you know, like some of the great, you know, like expanding market, you know, like Phoenix and again, like they're amazing. Just something to consider. And maybe they will not correct it. So Phoenix, Tampa, Fort Worth, Las Vegas, St. Pete, or other, like, let's say overvalued, call it currently market. Undervalued, it doesn't mean you should invest or one should invest there. Undervalued, it just means it's not going to drop once a systemic crash happens. Yeah. So undervalued markets do tend to be depressed often, but not always, because we saw, for example, the state of Texas was undervalued before the global financial crisis, and we know it was clearly like a place that was kind of destined for like preset for success even at the time. And so but the majority of undervalued places, probably they're undervalued because their prices are underperforming too much. Yeah. And these are places like Chicago and you know, Baltimore and Cleveland. And
I would not buy in Chicago.
But there are places like, look, Louisville, you know, in Kentucky is actually still undervalued. It was at least maybe it's gone, I don't know, but at least that's what the year end 2020 was still slightly undervalued, or actually not, like 8% undervalued, which is pretty good. So that's a safer, turns out, place than in that sense than, let's say, something in Idaho or Colorado. So yeah. So
I thought Neil liked Phoenix actually for 2021 actually.
I don't know his stuff. I actually haven't watched it.
I watched his market prediction. It must have been in March, but it was Phoenix, Arizona was his #1 market. He loves Boise, but Boise is a great one because he likes the INL. It's the power plant. I forget what they are, but they make power plants, or they make the research behind power plants, nuclear power plants.
Right. I mean, he does, because I mean, Phoenix is like one of the best markets, right? That's the same. This being overvalued doesn't make it that the best markets tend to become overvalued during a peak in the cycle. That's so.
Yeah, but how much does like population growth rent growth and unemployment numbers insulate that risk of overvaluation? What do you think?
Population growth, I think not much. An example is, I don't know, again, like a broad example, states. The state of Nevada has been booming in population, like for the decade of, let's say, 2000 to 2010 was booming in population, like huge population growth. And they had it, and then for this decade, and then 2010 to 2020, I believe they have close to 50% population growth, or 45. And so they were expanding in population, and they dropped in price because they were overvalued. So that's very interesting. Population does not protect. Another thing that, another thing, people think of foreclosures, or that, let's say, not on the opposite direction. Like what are right now, like what are some of, if we take a look at, undervalued states. So, okay, what current undervalued states, we take like the state of New Jersey and states like, kind of that haven't performed too well, like the state of New Jersey and Delaware, etc. And we say, if you look at the list of the foreclosure states, it's like the top 5, it's frequently headed by New Jersey, and there's like Delaware, Illinois, etc. It changes a bit. Like there's Atom Data Solutions is a vendor that posts some of that. And so these are kind of foreclosure places, but one, the overall foreclosure rates are not that high right now. So they're just the leaders in that. And two, it's not what predicts downturn supposed to peak, because if you look at the places that are that have the most foreclosures right now, they're the most undervalued ones. They're not likely to drop in price, even though they experience some foreclosures. So that's another interesting thing. Population, no. Now rent growth. Rent growth is sort of like price growth for commercial multifamily, right? In a way. And so then it maybe correlates to price growth in residential, let's say, high level, not perfectly, right? Mm-hmm. And so rent growth is just, that's the strength in the market, like now, like with COVID, like, unseen inflation, like places like Phoenix, I don't know what was the percentage, 20% increase in rent or something, like it's insane, right? So again, that's just a strength. That's a strength indicator. It's doesn't mean that the moment we reach a peak, then it's kind of, those are your like downside predictors, and that's all. But those places that have the strong fundamentals, I would bet on them to continue growing until they don't.
Right.
Yeah.
So pretty much. But if I have to bet, like, are they going to be? Is Phoenix going to be the one that's going to grow, or Chicago? Yeah, it's going to be Phoenix, of course. That's
there you go. Market. We got a couple of Phoenix people from here, so
yeah, sure.
No, we do not invest in Phoenix, though. Dang it.
But I think we're getting close on time here. We need to maybe do some breakout rooms.
Anybody have any other questions, real quick? I know you got a lot of data there, Stefan. It's great stuff.
Just points, because we don't have time now, but I'll just point the second topic. If you guys can look up, I have a channel on YouTube. It's called, like, it's my name, like Stefan Tsvetkov Finance Meets Real Estate. I did cover this topic there. It's like modeling commercial multifamily value add.
Oh, nice.
That one is kind of so it's kind of, I show like literally step by step, like how I use like my Python scripts to sort of like what is my Python code model to do it. It's for off market as well. I know many people are interested in off market, so that is the second topic that I had here. It's an alternative to, or like something to supplement, the usual approaches of broker relationships and then sort of direct mail to owners, but kind of more supplementing. But it's another approach to, okay, here, like if you look like at the end, I think in this study I pulled, and there is actually like one needs to hire an internet attorney for these things, and etc. Because I haven't purchased all this data, etc. But so here, if you look like in the end, they had like a study of like 104 cities, and this is where was it? 32,500 commercial multifamily properties. So they would be, let's say, they may have 100 units, 200 units, whatever. So they're off market, and it's kind of trying to get like preliminary insight into their income expense sheets and trying to gauge like what an investor is actually interested in. What would be the value add on this specific building? So that's kind of like, so that's about
Wow. What role do you play in the company? I could see you're the analytical guy. This is, how big was that?
I'm by myself. I'm private investor, so pretty much.
That's
the marketing road.
That's a valuable partner there, right? Like you need people getting that data on the back end because, if you're just going to pay for the data analysis, it's super expensive. But if you partner up with someone who's able to fill that role, and then you maybe partner with someone else who's, I don't know, good at something else. That's the key in the whole business and the whole area of real estate. So really powerful stuff you got.
Mm-hmm. Thank you, Chris. Appreciate it.
Yeah.
It's good stuff. Definitely. All right. So I think we got everybody's questions. Now everybody's just masterminding on where we're going to buy in Phoenix, but which is good. But so typically we do some breakout rooms right now. You'll get some one-on-one with Stefan, with everybody else in here to talk about deals, to talk about whatever you want to talk about, network, and grow opportunity here. So Stefan, thank you very much. We definitely appreciate all this. This is, there's a lot to digest there. And I think it's probably best that people do take their time and go to your YouTube channel. But you're welcome to stay around for the breakout rooms. In fact, we'd love you to be here, but you don't have to, don't feel obligated, obviously. So
thank you guys. It was great.
Thank you for coming.